Let's talk some stocks. Apple is shrugging off a price target cut from Morgan Stanley. Let's talk that first, Diane. What are they saying? Because it was a rough 48 hours for Apple, and it's positive right now.
It was. And look, to be fair, Morgan Stanley is still reiterating an overweight rating, which we know is essentially the equivalent of a buy rating. But they're lowering their price target on Apple to $252. Previously, their price target was $275. What's behind that? They say that there are some near-term challenges. They talk about that Siri delayed rollout, the advanced Siri delayed rollout, which I know we've been getting into recently, and the missing those new features that could potentially drive an iPhone upgrade super cycle. I know we've been talking about an iPhone upgrade super cycle for some time now, but they're saying that fiscal 2026, we might not see that because of this delay in that rollout. They've reduced their estimates on iPhone shipments for this year and next year, for 2025 and 2026, by 1 to 5%. Now they're forecasting 230 million units in 2025 and 243 million in 2026. So essentially, they're anticipating a flatter iPhone replacement cycle, and they're seeing that consumers just may hold on to their phones longer before upgrading. So that's why they're in part reducing. Also, they're factoring the potential for tariffs impact as well on this, and the higher just input costs that Apple may have to contend with to the reduction in their price target. And so they're reducing their estimates for Apple's fiscal 2026 estimates by 5 to 6%. They're projecting revenue of $436 billion, EPS of 8, which is slightly below consensus for Morgan Stanley.
Okay, so the fact that stock is hanging in there, I think, is really encouraging, because this is it's a pretty important analysis that they're doing. I mean, this is like bottom line deterioration to some extent that they see happening.
Yeah, I mean, look, and to be fair, there are some, right, they're still saying, I mean, they're still reiterating this overweight rating for Apple. It's got things in its favor. They've got the AI focus is just the delay of the Siri upgrade. So the services revenue growth is still, tailwind for the company, but just not enough to move the needle on where the price target is. And, I've heard from different voices that for all of these within the Mag 7 that, they're essentially technically oversold.
What's also kind of fun, a headline from the last 24 hours is apparently on their Vision Pro. Did you see that? Metallica's going to do an interactive concert. I mean, that's a pretty cool concept, because, everybody's going to Vegas to do the Sphere because it's this great physical experience. But, they could do that to some extent in a virtual realm that can be quite convincing. I was in the arcade last night where they got the virtual VR games now. It's wild. I mean, it's wild. It's worth going in. It's super cool.
The kids love that stuff. I mean, it's the way of the future.
Some adults too.
So obviously they're like, I was like, wait, how do I say this so that Ollie doesn't take offense?
All right.
From kids to grown-ups, we've got all the demos covered, is probably what Apple's saying. So that is certainly generating some buzz when it relates to, kind of Apple's more progressive segments that it's leaning into. We'll see if this turns into any kind of momentum, but Apple does look pretty range-bound right now.
Okay. All right. That's, I think, a helpful thing today with Apple. Trying to hang in. Trying not to get distracted by the fade in S&Ps right now. Let's keep going. Capital One, up 3%. Upgrade here. I think this is a pretty big one. This stock is very much one that we watch for deterioration in the consumer. And if this analyst is upgrading it, that's got to be a good comment.
And look, they even looked at the consumer and kind of talked about that as well. They've upgraded it. This is Evercore ISI. They're upgrading Capital One to outperform. They previously saw it as in line. They are keeping the same price target, but there is room from here. The price target is 200. They just see there's undervalued potential here. They think that Capital One's valuation does not fully reflect the long-term earnings growth trajectory, return potential, especially post post the Discover acquisition. They see, just upside from here. The big catalyst being that they think they'll have a stronger combined franchise with Discover in terms of both credit card, digital banking. They believe that merger set to close this year will be a catalyst for Capital One. It will give it greater scale, also has synergies with it. Greater payment processing capabilities, more access to merchant fees and transaction revenue. So they see that as a boon for Capital One. Now, of course, they talk about, kind of the consumer risk, that there is a risk from a softer consumer environment that could impact, say, credit card spending, loan performance as well. But they don't see, that denting the, in other words, they see the catalyst from the tie-up with Discover being a greater catalyst to offset any kind of deterioration that we may see in the consumer. There is some risk there, though.
Okay, that's very interesting because then the kind of macro takeaway that I was implying it does not apply. Is basically what the analyst is saying, because I was hoping that this is more about the creditworthiness and the stability, but they're just talking about the deal here. They're even saying that this might help for deterioration to offset deterioration in the credit space.
Essentially, that's what it looks like. They just see upside optionality with regard to this deal, even in the face of potential credit headwinds. So I guess they think that will provide a big enough moat.
Yeah. All right. Okay. Let's hit Pepsi real quick. Downgrade there. I was kind of joking with KG earlier, though. If you want to sell staples, go for it. All that matters is big tech.
Yeah, that's fair. The Jefferies downgrading Pepsi to a hold. They are also reducing. They previously had a buy on it. They're reducing their price target to 170. They think essentially there's just limited upside from here, especially after the rally that Pepsi saw from its January lows. They also highlighted the struggles in the Frito-Lay division. They say that segment just continues to underperform, and that's going to weigh on the valuation multiple and just growth outlook. And then, while international markets remain strong, the U.S. operation is still struggling, and they pointed that out.
Okay. Appreciate that. Thanks very much, Diane. Okay, so stable, it seems, at Pepsi. That's kind of what the staples do. Hold, fine.
Yep.
All right. Yeah. Apple red, barely, though. Basis points. We'll see if it can turn around. Market did take a little bit of a hit there. So we're chopping.